Hello, welcome to the first lecture. So, as I mentioned before, in this lecture, we will talk about accounting standards and why do we need accounting standards and what are the arguments in favor of it, how the accounting standards has been developed, and if there is any arguments against accounting standards. I know some of the issues may be difficult for you, but try to understand, try to get an overview of accounting standards, and I'll try to make the things easy and don't like to overload lots of information. I'll just maybe go through and give you some sorts of understanding on it. So in this lecture, what we will see the why we need accounting standards and standards of accounting standards in UK and EU, and there are different directives have been provided uh, in the EU's countries, and what are the convergence of accounting standards in the UK, and particularly so when there is a kind of combined accounting standards with US, when it started and how it happened, and what are the advantages and disadvantages of accounting standards, and why financial reporting differs between the countries or between organizations, and in particular um, for the smaller enterprises. All right. So let's see the role of accounting numbers in defining contractual entitlements. As you know, different people works in the organizations, right? So, which people has what kind of rights in the organization is been determined by accounting numbers. For example, the remunerations of the directors. All right. So, uh, the remuneration or the entitlements of the remuneration is basically depend on the profits of the organization. All right. And you know, the directors are the um, people who run the organization, who manage the organization. So if they say um, because of uh, the variation in the profit, if profit decrease, the um, emoluments of their salaries will decrease. So in that case, they will try to influence the amount of salaries. Um, how they can do it, they can change the amount of profit in different way. All right, and that's why you need accounting standards, so that you have to follow a particular standard so that the directors cannot change the amount of profit. Yeah, so this is what I mentioned. If the risk earnings will not grow, all right, at an attractive rate to the directors, then um, they will try to change the amount of profit in different way. They will try to influence the amount of profit or the change the amount of profit in different way. So what are the measures they can take? So what they can do, the directors can defer the discretionary expenses, right? So some of the expenditure like advertisement, the director will think, oh, if I give advertisement, then profit will decrease, so I'll not give advertisement. If I spend some money for um, research expenditure, training expenditure, then profit will decrease. So I don't like to spend any money for profit, for research, for advertisement. So this is how they want to improve the amount of profit so that they can get more salaries. They can defer amortization or depreciation expense, or they can lower the rate of depreciation, so profit will increase, or reclassifying of assets. So this is how the directors try to influence profit so that they can get more salaries. Right, and that's why you need accounting standards. So the directors cannot do whatever they want. So we want to make sure that you understand from here that why we need accounting standard. All right, I'm just giving you some sorts of background or some kind of a contextual information to make it easy so that you can understand why accountants need to follow accounting standard. This is why mandatory standards change management ability to adopt such measures, right? So if there is mandatory standards, this is how you have to prepare financial statement. In that case, the director should not be able to um, influence the amount of profit, influence the amount of expenditure or revenues if as they want. Okay. Uh, yeah. So if they follow a particular standard, then all right, so what will happen? The standards are required, the mandatory standards. They have to follow these standards, and and then it would be difficult for them. Why it is difficult to obtain a consensus, right? So each party considered the, and this is why we need accounting standard. We are talking about that, all right? So if there is no standard, then someone will say we can record financial statement in this way, someone will say we can follow that way. So it's very hard to make a consensus. Um, and also, I'll think an information, I'll think a transaction from my perspective as an employee or as a management, they will think something in different directions. So they cannot come together, right? So that's why we need a particular standard from the regulatory bodies to follow it. Why there is a need for mandatory standards? As we mentioned before, there are some other arguments. Mandatory standards are needed to define the way in which accounting numbers are presented in the financial statements. This is a particular standard way we have to follow. And if this is how we do prepare our financial statement, then it would be less subjective. It would not be questionable why you did this way. There is no question about it. There is a standard, we followed it, this is how we record. And obviously, if all the organizations follow the same process, it would be an uniformity of disclosure. Everyone's financial statement would be similar, same kind of. It would look like the similar financial statement. Obviously, this is how, right, the accountants would be able to regain the confidence of the people that they lost, right? People don't like to believe on the financial statement because of some consequences. You know, Enron and other big corporate collapse reduced the confidence of the investors on the financial statement, financial reports, right? And that's why we need a particular standard. And if all the organization follow those standards, and then it can regain the confidence of the investors and users of the financial statement. And most importantly, the owners of the organization are the shareholders. And I'm a shareholder, for example, and I have purchased some shares of a company which is operating in USA. I don't know what's happening over there. I can see only the financial statements, only the reports. So I'm not aware what's happening in practice in the organization, right? And that's why the financial statement should not be inaccurate, should be accurate, right? If it is inaccurate, right? So what will happen? The people will try to misuse those, right? Their power. They will try to use those resources in their own interest, right? So, and particularly in UK, if you say GEC, and AEI's ownership changes of the organization. And Pergamon Press, because of their situation, right, that actually the owner couldn't understand what's happening in the organization, right? Because the financial statement that they prepared before actually didn't reflect the accurate financial picture of the organization, right? Because at that time, there was no accounting standard that you can follow. And that's why we need a standard, right, to protect the interest or the capital of the shareholders, what they invested in the company. So as we mentioned before, GEC's takeover. What actually happened, if I say in a nutshell, before the takeover by AEI, what they did, GEC prepared the financial statements before takeover, and they showed um, the profits of the organization was 10 million in November 1967. All right, this is what they focused, and this is what the profit they showed in their financial statement, right? But what happened afterwards? Um, the focus was kind of a blessings of the auditors. Why? The auditor says the financial statement is fair, reasonable, all right, and it is being consistent with the principles followed in the annual accounts, and that's why they say, oh, this is correct, right? The investing public would normally have been quite satisfied with the forecast figure, all right, and the process by which it was produced, all right, but AEI would not subsequently have produced other information. What was the basis of this forecast? And then what happened? AEI focused used the same information and used the forecast, and then what they found, you can see here. Oh, it's not 10 million profit; it was actually 4.5 million loss. All right. So what happened? What's the difference? 10 million profit, and on the other hand, 4.5 billion loss. The difference is actually 14.5 million. All right. This is what the forecast AEI made, right, in 1967, the same time, right, using the same information that is being used by GEC. All right. And that's why, based on which the investors lost their confidence on the company's financial statement, right? Auditors are saying, yes, this is right, but actually they are not producing the correct information in their financial statements. All right. So why this big difference can happen? Two ways it can happen. 14.5 million difference. Either the fact have changed or the judgment made by the directors have changed. And of the two. And then it was seen that what about the facts? Changes in the facts. The facts were actually 5 million, right? And 9.5 million difference happened because of the judgment. So the 5 million changes because of profit or loss in relation to revenues and expenses, and 9.5 million difference was because of the judgment in case of evaluating the assets of the organization, assets and liabilities. So, yep, public view of the accounting profession, right? So what happened afterwards? People understood at the time that accounting is not an exact science. They understood that you can't say exactly what would be the value of furniture after a certain time. You can't say what's the value of the stock you have exactly, but it should not be a huge difference, like 14.5 million. And that's why the people actually felt they need some sort of action. What is that? You need a particular way of presenting the information. So that's why you need a particular standard, right? This is how you have to record revenues. This is how you have to record assets. This is how you have to show the liabilities in your books of accounts. So what we understood from these discussions that we need a particular accounting standard. Don't think, oh, there are lots of things. We didn't understand what these actually mean. So from these slides, we actually understood that we need an accounting standard to present the information correctly in the financial statements, so that as the users of the financial statement, we can understand what does it actually mean. And organizations also provide this information accurately. And that's why the accounting professionals responded, right? So they try to fill this gap, right? What actually happened, and also accounting accountants were also under pressure. Different kind of, there was no this what you can say as true and fair view of the financial statements, right? So they try to just follow what they prepared before, other people, how they show the financial statements, right? So they try to copy or see how other people are doing, because there is no specific guideline, right? And auditors were also under pressure, because the if other people say, oh, there is no these are not accurate, but as an auditor you said these are accurate, it's uh, kind of a misunderstanding between the parties. So an embarrassed profession announced in 1969 by the International Cost um, Accounting Institute of Cost Accountants in England and Wales, that there was a pressing need for introduction of accounting standards. This is what the process actually started in 1967, that we need a standard to prepare our financial statements. All right. And also, why we need accounting standards? Because of comparability. If you have a standard, then you can compare your financial statement with someone else, right? For example, you prepared financial statement in one way, I prepared my financial statement in another way. So what will happen? It cannot be compared, right? So if we both follow the same standard and prepare the financial statement, then what will happen? We can compare it. And then we can, as an investor, we can make a decision, should I invest in this organization or that organization, right? But if you can't compare, if different organizations follow different accounting standard, then it would not be comparable and you would not be able to make a decision, investment decision. And also credibility. In terms of credibility, obviously, if you want to see that the financial statements are accurate, if you want to see that the financial statements are acceptable to you, then what you have to do, you should you should prepare the financial statement based on a particular standard. It should have some sort of standard. You should maintain that standard. You should provide the information that you are supposed to provide in the financial statement, right? And it should be uniform to other organizations, right? Uniform to a particular standard. It should provide the true and fair picture of the organization in the financial statements, right? Yeah, and also influence, right? Um, the process has stimulated the development of conceptual framework. So the second chapter we'll be talking about conceptual framework, the foundation, the basis of um, accounting standards or basis of reporting or accounting, right? So people understood that we need a conceptual framework. We have to develop some standard, right? So they need to think what are the basis, how we can prepare the standards, right? So then they develop the conceptual frameworks based on which accounting standards were being drafted or prepared afterwards, right? It's a statement of accounting principles. But obviously, there are some arguments against accounting standards. All right. So, what are the arguments against accounting standards? So, it has some economic consequences as well. So, if you want to prepare financial statement based on a particular standard, then you have to, or you need to hire some accountants for your organization. You should prepare some mandatory statements which requires use time and cost. So it can be costly for some organizations. So obviously it would be kind of additional cost to the preparers on the organizations, right? And also suboptimal managerial decision might be taken to avoid any reduction in the reporting earnings. That means if you follow a particular standard, if you prepare your financial statement in that way, your earnings is getting down. So you may take some sorts of decision to improve your profit, right? This is what can happen in some organizations which are not under scrutiny or under strong regulations, or in some countries where corruption is very prevalent, can happen there. And also consensus seeking, right? As we mentioned before, it's very hard to make a consensus, and also some leading organization may have some sorts of influence on the people who are producing the standards. So some people may influence standard making process. If this is what happened, then it would not be a right standard to follow by all organizations. So obviously, and that's why ABS, Accounting Standard Board, tried to or attempting to minimize some sorts of those kind of influence to make the standard impartial, to make the standard unbiased and kind of standard for all the people, all the organizations. And also some other arguments against standards are there are lots of standards, too many standards. Different organizations are producing standards. There's some US standards, Malaysian standards, UK standard, or some Islamic organization produce some kind of standards. Some traditional or conventional organization producing different standards. So, and standards are too detailed. It's very hard for some people to understand who doesn't have expertise on that particular area. So it's very hard. And also for particularly for smaller entities, they cannot cope up with those, right? And also if you see the standards set by FASB, Financial Accounting Standard Board, or International Accounting Standard Board, or Accounting Standard Board, or National Stock Exchange, or there are lots of London Stock Exchange or listing requirements, huge requirements or standards. People or organizations are kind of overloaded with the standards. It's very hard for them sometimes hard for them sometime to follow or cope up with all those regulations. And that's why some people don't like, oh, too many standards. Yeah, this is a kind of an argument on accounting against accounting standards. So this is up to the first part of the video. So I'll talk about some other issues in the next part of the video. Thank you. Thank you very much for watching.